Good morning, ladies and gentlemen. Welcome to Mpact Limited's interim results presentation for the 6 months ended 30 June 2022. Bruce Strong, CEO, and Brett Clark, CFO of Mpact, will be taking you through the presentation. Should you have any questions, please submit your questions by using the question tab at the bottom of your control panel, which I will post to Bruce and Brett on your behalf at the conclusion of said presentation. And now I hand you over to Bruce Strong to take you through the presentation.
Thank you, Mollies, and thank you everybody for joining us. Brett and I will do the presentation together, after which we'll happily take your questions. Impact's trading for the 6 months ended 30 June 2022 improved mainly on the back of strong local containerboard and cartonboard demand, good growth in new product sales, and higher selling prices implemented at the end of 2021 to cover sharply escalating input costs. Across the other parts of the business, trading was mixed, with good sales volume growth in the QSR, beverage and home delivery sectors, offset by declines in other FMCG sectors, as well as the fruit packaging. The Bay White distribution agreement with Mondi terminated at the end of December 2021, with only minor inventory clearing sales of Bay White taking place during the first quarter of 2022. Fruit packaging has been impacted by the uncertainty arising from the Russia-Ukraine conflict, as fruit producers have delayed decisions on harvesting and packaging of some products until they are able to establish which markets to service and how. The operations were also impacted by a number of other factors, including port constraints in South Africa and adverse weather in some regions. This in turn affected sales of corrugated fruit boxes as well as plastic bins and crates, which decreased from the 6 months ended 30 June 2021. Persistent global supply chain constraints continued to impact the cost and availability of most raw materials and also new capital equipment. Where possible, we increased raw material inventory to mitigate long lead times and periods of uncertainty. This hasn't been possible in the case of some key products such as kraft liners and semi-chemical fluting, which we procure externally. Finished goods inventory also remained below targeted levels in most businesses. Consequently, despite our best efforts, there have been some instances where customer service levels have suffered. Despite these external challenges, there has been meaningful progress on the implementation of our strategy. This includes a number of capital investments for future growth. These have, to some extent, been hampered by delays in the manufacturing and shipping of capital equipment for a number of projects, ordered mainly from Europe and Asia. This has impacted completion dates, most notably of the plastic containers Castle View project. We have, however, contained project costs to within the approved budgets, with a few exceptions related to exchange rate movements and the above-mentioned delays. In addition to these global challenges, we have successfully navigated the lingering effects of last year's riots in KZN, the recent floods in KZN, drought in the Eastern Cape, unprecedented load shedding, and other municipal service interruptions countrywide. So, like many other manufacturers in South Africa, our resilience is being tested and proven every single day. While many of the above-mentioned factors have been challenging, some also present opportunities for our business, which we'll continue to exploit. I'd like to take this opportunity to thank all of my colleagues and our board for their unwavering commitment to our business and our customers, and for pitching up every single day to make sure Mpact is in good hands. Mpact Operations Pty Limited, our main trading entity in South Africa, retained its level 1 BEE rating in May. This rating is underpinned by the 10% shareholding by the Impact Foundation Trust, which has already provided 48 fully funded bursaries since inception, and our enterprise development efforts, which we achieved over 100% due to the support given to small businesses through our recycling business. The group's committed debt facilities were renewed last week for periods up to 4 years at improved margins, and Brett will take you through the details of that a bit later. Moving on to the financial review. As announced earlier this year, the board has decided to sell the plastic trays and films business, Mpact Versapack, as a going concern. As such, Versapack is disclosed separately in the financial statements, with the assets and liabilities being reported as held for sale and the income statement reported as a discontinued operation. The financial information in the following slides relates to continuing operations, which therefore exclude VersaPack. I will nevertheless deal with VersaPack separately in the presentation. Group revenue for continuing operations increased by 5.2% compared to the prior year to 5.7 billion rand. To better explain actual trading though, I'll also provide figures excluding Baywhite where appropriate. Revenue excluding Baywhite increased 13%, with sales volumes up 6.3% on the back of the increased paper volumes, which were partially offset by a decline in plastics. Average price, which includes a mix variance, increased by 6.7%. Underlying operating profit increased by 21.5% to 387 million rand, mainly attributable to an improvement in the paper business, which was partially offset by a decline in plastics. The depreciation charge declined by 2.5% compared to the prior period. Underlying basic earnings per share increased 28% to 139 cents. Return on capital employed, another key metric in our business, increased to 18% from 15.4% in the prior year. Our current weighted average cost of capital is approximately 13%, up from 12.7% at the end of March 2022. Gearing was 33.6%, with net debt in line with expectations at 2.2 billion rand, mainly due to improved investments in capital projects and higher inventory costs. I'm pleased that the board has approved an interim dividend of 40 cents per share after 2 years without one. While this is below our targeted 3 times cover, the board has opted to take a more conservative view at the interim stage, but leaving options open for the final dividend based on the full year performance and other capital requirements. Moving on now to the segmental analysis, starting with the paper business. Paper business revenue of 4.9 billion rand was 5.9% higher than the prior period. Baywhite revenue was 68 million rand compared to 431 million during the first half of last year. This reflected inventory clearing following the expiry of the distribution agreement, as I mentioned earlier, in December 2021. So I've provided most of the numbers now excluding Baywhite, just so it's easier to understand. Excluding Baywhite, paper segment revenue increased 15.3%, with sales volumes increasing 7.4%. The average price, which includes a mix variance, increased by 8%. Recycling external sales volumes increased 33%, with the benefit of the acquisition of 2 new businesses in November last year and a full recovery in the glass sector from the alcohol bans of last year. And for those who don't remember, we are quite a big provider of recycled glass to the glass producers in South Africa for beverage bottles. Total sales volumes of containerboard and cartonboard, excluding Baywhite, but including interdivisional sales, increased 1.8%, with a 13% increase in domestic sales, offset by a decrease in exports. This resulted in a favorable sales mix variance compared to the prior period. Paper mill capacity was fully sold for the period. However, production at the Mkhondo and Springs paper mills was hampered by power dips and water supply interruptions, and also some adverse weather, amounting to approximately 2% of our total capacity for the year, for the period. Paper converting sales volumes improved by 1.2%, with good growth in the industrial and quick service restaurant sectors, offset by lower sales to the fruit sector. The increase in the industrial and QSR sectors is mainly due to increased consumer demand compared to the prior period, during which there were still lockdowns and curfews in place. Beverage volumes, both alcoholic and non-alcoholic, are up significantly. The recent bout of load shedding may have also contributed to increased QSR demand, where people were buying fast food instead of cooking at home. Strong growth was experienced in new product sales, albeit off a low base, as home delivery and courier bags and fresh packed punnets and trays are seeing sustained demand across most of our product categories. All of these gains more than offset the loss of business due to the KZN floods, which resulted in some paper converting customers shutting for a few months in the first half. In the fruit sector, avo, citrus, grape, tomato, and stone fruit volumes were all down, for reasons already mentioned, while banana and palm fruit volumes increased. Underlying operating profit for the paper business of 458 million rand was 32% up on the prior period. The results do include the final settlement amount of 47 million rand received by Mpact from the insurers relating to the Springs municipal electricity supply interruption in 2020. Direct costs relating to the recent floods in KZN amounted to 5 million rand in the paper business. The increase in the operating margin is largely attributable to better trading and lower bay white sales, which historically yielded an operating profit margin of approximately 2.5%. Moving on now to the plastics business. Once again, I'd like to remind everyone that this segmental report excludes Versapack, which is reported separately as a discontinued operation held for sale. I will deal with Versapack also separately on another slide. Revenue in the plastics business increased by 1.2% to 849 million rand. Sales volumes declined by 6.4% due to a reduction in bins and crates, while FMCG was in line with the prior period and preforms and closures increased by 1.5%. Average prices increased by 7.6%. Production of bins and crates was lower than the prior period due to delays in the arrival of new equipment from overseas and in part to operational issues impacting sales. This equipment was required to offset the planned relocation of existing equipment between plants as part of the establishment of the new Castleview factory in Gauteng. Additionally, bin sales to the fruit sector declined for the same reasons as in paper converting. The FMCG business was affected by 7 days of downtime at the Poundtown factory, attributable to the floods in KZN. We were able to meet all customer requirements utilizing our capacity in other plants during those floods. Underlying operating profit in the plastics business decreased to 3.5 million rand due to lower sales volumes. The costs associated with the recent KZN floods of 11.6 million rand are included in the current period results. An insurance claim is being processed, but has not yet been recognized in operating profit. The consolidation of the two preform and closure factories in Wadeville is progressing as planned, with completion expected by the end of this quarter. I'll now move on to the Versapack operation, the Versapack business, which, as I said, is reported as a discontinued operation. So in Versapack, revenue was up 19.2% to 510 million rand, and that despite sales being lower due to product rationalization and lower demand in the food sector. Prices increased to recover higher polymer costs, which has been previously reported. I mean, the polymer costs have escalated rapidly. Underlying operating profit, as reported, increased by 53% to 28 million rand. But I must point out that this excludes intercompany costs of approximately 24 million rand, which is as per the accounting standard for discontinued operations. And these are being carried by continuing operations at this point in time. These include packaging costs, amortization of right of use assets, which total 16 million rand, and group services, which includes ICT and some management fees of 8 million rand. Engagements with potential buyers for the Versapack business are ongoing. Following hereafter, and now I'll take you through some capital investment updates, on the slides that we've presented previously, starting with our investment at Bridge City in KZN. So this is our new recycling facility. So when I first looked at the picture, it looked like a CAD drawing, but it's actually the actual facility, which has been completed, has been trading since May 2022. And here's a short video just to give you a quick overview. So there, it's encouraging to see after, I'm just thinking back to around April 2020, when we were all in the doldrums of COVID, the first lockdown, and we were discussing this project, and now to see it 2 years later up and running is very encouraging. And I must say, to see all these projects progressing does give us good confidence for the future, notwithstanding some of the challenges that we do face in South Africa. This slide shows the update on the plastic containers recycling facility in the Northwest Province, Brits. That has been completed in March and been in operation since March this year. It isn't optimized, it's still being optimized, and we are very enthusiastic about what this brings to our customers in terms of enabling them to have their bins and crates recycled, so we can supply the new bins and crates with recycled material. So closing the loop for those customers even more than what it is today. The next slide is the update on the Castleview factory in Gauteng. And on the bottom right, you can see the roof being raised. The main reason for raising the roof is because we've decided, and our board has approved, that the automated warehouse that we previously spoke about should be twice as big as what we originally anticipated. So now it's going to be 10,800 pallet or fully automated warehouse. Needed a higher roof, and the higher roof also enables us to put in more solar capacity. So that's in addition to what we've shown previously. In terms of the phase 1 and 2, which was originally shown as 178 million rand, that's still on budget, but has been delayed by about 6 months due to some of the equipment delays. Notwithstanding that, we still have the 4 machines operational at the moment. We're targeting 8 by year end, and by the end of the first half of next year, we'll have 9. The total capacity, or at full capacity, this plant will have 15 machines with state-of-the-art everything. And I must say, we've seen quite a bit of pressure in the sector among our competitors, and we're very pleased to be investing in a time in a very profitable business and seeing the benefits of that come through. So notwithstanding some of the delays, still a very exciting project that will deliver great returns in future as well. If we look at the next slide, that shows the projects in our paper converting business. So there the project pool has expanded since we last spoke, and it includes a number of upgrades to factories based on the tremendous growth we're seeing in the fruit sector. Most of the projects are under construction, equipment on order, and progressing reasonably well under the circumstances. So also exciting growth prospects here, enabling our customers to rely on us well into the future in terms of their packaging requirements, especially in the fruit sector. On the next slide, you'll see an update on our solar installations. So since we last spoke, we've added the projects that are completed. So as we promised, a number completed by mid-year this year, and by the end of the year, we're just finishing actually the Felixton ground mount, 1.8 megawatts. So that'll bring us by the end of August to about 10.7 megawatts of installed capacity, and that is being utilized. On the bottom right, you'll see the next in pipeline. Castleview has been postponed until we've raised the roof now, because we've changed the scope there a little. And the next to Mbombela, we will progress in the near future. And the Springs paper mill solar installation was originally estimated at 2 megawatts, but after doing quite a bit of work and learning from our Felixton project, we think now we can put in 5 megawatts. So we look at the entire scope there of 17 odd megawatts of solar. The total investment would be 170 million rand, but I should just point out that the Mbombela and Springs projects haven't yet been approved. So the total committed capex is sitting at around 105 to 105 odd million, around 10, and in total, we're now looking at about 10 rand per watt, which is up from the original costs that we had right in the beginning when we were paying between 7 and 9 rand. We have seen an escalation in solar costs, but still at 10 rand a watt, these projects are still very much viable and are showing great returns already in our business. And the next slide just shows some of those installations. So you can see on the top right, our Felixton paper mill, and the bottom right. The top right, you'll see the roof mount that's on our automated warehouse in Felixton, and you can also see some of the ground mounts. In the bottom right, you'll see what the ground mount looks like actually at ground level. There are a number of other ground-mounted installations there on grass fields, which have also been partly commissioned. And I must say, been amazing to see. Our own teams have designed and installed these to a large extent. And the latest addition has been 6 sheep that we've had to put on the grass to mow the lawn, because you can't mow the lawn with lawn mowers or weed eaters, because it shoots up. Those stones are shot up, and they break the panels. So even sheep are included in these operations. And then the other 3 pictures, you'll see our plastics business in Atlantis, complete solar installation there, paper converting in Gqeberha, Eastern Cape, and our Bridge City recycling facility as well. So I'd now like to hand you over to Brett, who will take you through the financial performance.
Good morning, and thank you, Bruce. Variable cost of sales of continuing operations, excluding Bay White. During the period, Mpact experienced significant cost increases on the back of global inflation and supply chain constraints. Paper business raw material costs, excluding Bay White, increased by 27%, of which 7% relates to an increase in volumes and 20% to price or mix variance. Recovered paper, which comprises a third of Impact's total paper raw material costs, increased 25% when compared to the prior period. As you can see from the benchmark polymer price graph on the bottom right-hand side, plastic raw material prices also increased significantly during the period. Sales volumes decreased by 6%, with price mix variance up 11%. Selling and distribution costs increased 13% on the back of higher sales volumes and increased transport costs. The increased costs were partly offset by a favorable mix due to lower export volumes. Other variable costs, including chemical packaging and staff costs, which also increased well above inflation. Fixed costs. Personnel costs were up 4.4%, reflecting salaries and wage increases during the period, partly offset by staff reductions due to the consolidation of the plastics preform and closure sites in Wadeville, as well as lower leave pay provisions. Maintenance and net operating costs increased by 16%, made up of maintenance costs, which increased due to above inflationary increases in the cost of critical spares and negative impacts of load shedding and power surges on machinery. Operating costs increased on the back of higher insurance costs, new operating sites, and an increase in provision for doubtful debts. A higher depreciation charge for the period was offset by the reassessment of useful lives of certain assets in the prior year. Financial review. Underlying profit before tax increased by 24% to 311 million, benefiting from strong local containerboard and cartonboard demand and higher selling prices implemented at the end of 2021, which were partly offset by lower sales volumes in the plastics division and sharply escalating input costs. Basic earnings from continuing operations were up 25% to 202 million, with underlying earnings per share increasing 28% to 138.9 cents. ROCE and net debt. Return on capital employed grew from 15.4% to 18%, reflecting the increase in earnings, partly offset by higher capital employed. The group's net debt, as at the 30th of June, closed at 2.2 billion, an increase of 450 million from the 31 December 2021. This reflects the increase in investment in capital projects and working capital. Gearing increased to 33.6%. Net finance costs and net debt. Looking at the second line on the table, average net debt increased by 19% to 2.1 billion. The higher average net debt coupled with higher interest rates, meant that net finance costs for the period increased 21% to 82 million. Interest cover remained flat at 4.7 times cover, with net debt to EBITDA at 1.5 times. Renewal of debt facilities. Mpact has recently renewed its long-term debt facilities of 2.6 billion at lower margins. The funding comprises a 367-day notice facility and 3 and 4 year term funding. The debt covenants remain unaltered. The term funding now includes a sustainability-linked 5 basis point benefit or penalty, depending on whether carbon emissions and water efficiency targets are achieved or not. Working capital. Raw material inventory was increased for a number of product lines during the period, where long order lead times and uncertainty of raw material supply has been experienced. In addition, agricultural debtors increased due to interruptions in agricultural exports caused by supply chain and port delays. Trade working capital as a percentage of revenue increased to 19.6%, of which 2 percentage points of the increase when compared to the prior year relates to the termination of the Mondi Baywhite distribution contract. Movements in net debt. Mpact generated 688 million in cash from operations before working capital. Of this, it invested 595 million in new buildings, plant and machinery, and a further 208 million in working capital, as well as the payment of a final dividend of 74 million. This resulted in net debt at the 30th of June of 2.2 billion. Taxation. Mpact paid tax of 92 million during the period. The effective tax rate for the year is estimated at 29%, marginally higher than the statutory rate of 28% due to the non-deductibility of certain expenses. Capital expenditure cash flows. Mpact is fortunate to be in areas of the economy that are forecast to show significant growth going forward. In order to capitalize on these opportunities, a number of expansion projects are underway. In paper converting to supply the growth in agriculture, and in plastic containers, the new Castleview production and Brits plastic recycling facilities are now operational and being scaled up. In addition, as you would have seen on Bruce's presentation, the benefits of solar are also being pursued. During the period, 595 million was invested in capital projects, of which 293 million was in the paper business and 160 million in the plastics business, and 142 million shown under central, which is mainly invested in various new facilities in paper recycling. Capital expenditure of 1.2 billion has been approved and has not yet been spent, of which 739 million has been contracted for. Dividends. The board is pleased to declare an interim dividend of 40 cents per share, which equates to a cash dividend of 59 million. Thank you, and I'd like to hand you over to Bruce.
Thank you, Brett. Moving on now to the outlook. Mpact is expected to continue to benefit from the strong domestic containerboard and cartonboard demand. And all paper machines are fully booked to the end of the current annual supply agreements, being the end of September this year. Current indications suggest that the supply and demand balance will remain tight for the foreseeable future. Input costs, however, have continued to escalate since the end of June, putting further pressure on margins. Discussions are currently underway with customers regarding selling price increases to be implemented in October across the paper business. The Felixton Paper Mill project, which aims to increase recycled containerboard capacity by an additional 16,000 tonnes per annum, is on schedule to be completed in 2023, and further paper mill projects are under consideration. The Citrus Growers Association is still forecasting growth in citrus export volumes from South Africa for the full year of 2022 when compared to the prior period, notwithstanding a decline in the first half of the year. If this materializes, we would expect to see a benefit in both the paper converting and the plastics bins and crates businesses. Margins in the paper converting business will be under pressure due to the substantial containerboard cost increases expected in the last quarter, which may not be fully recovered in selling prices. Various projects to increase Impact's corrugated capabilities to service a growing export fruit sector, and in particular citrus, are expected to be completed by the end of 2024. These include investments at our operations in the Western Cape, Gqeberha, and Mbombela. The plastics division will benefit from the consolidation of the two preforms and closures factories in Wadeville later in August, and an improvement in the bins and crates business is anticipated during the second half. The new plastic crate recycling facility in Brits and the development of the new Castleview factory are also expected to contribute more meaningfully during the second half of the year. Currently, 4 machines are operational at Castleview, with a further 4 planned for commissioning by year end, as I mentioned earlier. At full capacity, the plant will operate 15 injection molding machines and a fully automated 10,800 pallet warehouse. While we anticipate the continued negative impact from ongoing global supply chain constraints, market uncertainty arising from the Ukraine war and its effect on the costs of energy and food, and the current cycle of monetary policy tightening globally, Mpact will continue to invest to meet customers' requirements and extend our innovative product offering. Importantly, several of our products are targeted at sectors which are expected to grow in the foreseeable future and are partly shielded from South Africa consumer spending patterns. These include fruit exports, convenience shopping, recycling, and total waste management. Impact's integrated business model is uniquely focused on closing the loop in paper and packaging, positioning the group to benefit from the ongoing drive towards a circular economy by brand owners, manufacturers, and governments alike. Customer inquiries about locally sourced paper-based and other sustainable alternatives to single-use flexible plastic packaging have increased in the recent past. We expect this trend to continue, given the recent implementation of mandatory extended producer responsibility fees for paper and packaging products in South Africa. In the face of the continued macroeconomic uncertainty, the focus of the Mpact management team remains on the value-enhancing strategy of the business, aimed at optimizing our portfolio and growing organically and through acquisition. This strategy has enabled the business to report stronger earnings as the company continues to innovate and evolve into new higher margin product areas, creating tangible returns for all shareholders. Thank you very much for listening, and just after the short clip, Brett and I would be happy to take any questions you may have.
Thank you, Bruce. Just a kind reminder that you can post your questions by using the question tab at the bottom of your screen. The first question is from Murray Moore from Aylett. Can you explain what the issue with the fruit sector was?
Yeah, so thanks for the question, Murray. So as I mentioned, you know, in the first instance, a lot of producers were uncertain about, you know, the logistics of getting their fruit, especially some of it going to the eastern sort of side. So it was around containers and availability of containers, impacted to some extent by the sanctions that were brought against Russia. Although it seems that we are still exporting fruit to Russia. In addition to that, there were some port issues through the period, both related to the floods in KZN, but just generally. In some of the other product segments, I didn't mention it specifically, but there were some, in the tomato segment, there was a virus that affected volumes, for example, and there was weather in avos where a number of orchards, number of avo producing areas were hit by hail. And avo producers, because of prices, have also decided to hang fruit a little longer than normally. So there were a variety of factors that related to the fruit volumes not being the same as in the past year. But as I did say in the outlook, you know, according to the Citrus Growers Association, because citrus is the biggest volume in fruit packaging in South Africa, they still expect to see the volumes up on last year by the end of the year. And if that materializes, then we should see some of that volume coming through. So there were a whole host of factors in this period that affected the volumes.
What confidence do you have that H2 is going to be so much better?
Well, I think let's just put it into context. You know, H2 last year was a good half for us, so we could do that well. We'd be very happy with that in this year. There are a number of factors. We're seeing strong demand across most of our businesses still. The big challenge, I guess, is the inflation, you know, and being able to recover the cost increases. So even since the end of this period, you know, from the beginning of July, we've seen costs continue to escalate. If we are able to recover the cost increases through selling prices, then I think we should see a performance that is certainly reasonable. The big challenge for us is on the converting side to realize those prices, selling to the various customers on the front end of that business, box prices, because we are facing quite high input costs in terms of containerboard, and being able to recover those input costs may be a challenge in the period. But still, we are diligently working at that, and you know, we are confident that we'll be able to deliver a reasonable performance, but it's hard to say exactly what that would be at this stage. If I could just add, sorry, while just seeing that you asked the question, I mean, there are a number of projects that we are bringing on stream now, you know, so for example, the Castleview project, which battled in the first half, hopefully some of those returns will start to come through. And same with the recycling projects, the one in Brits and also the one in KZN. So we should see some of the benefits of that coming through. And we've got a number of other projects, as I shared, which should benefit us, not necessarily in this period, but in the periods that follow.
Thank you, Bruce. Utumela Mahudu from M&G Investments. The plastics division reported revenue growth of 1.2%, but what appears to be an unusual decline in EBIT, even if one excludes the impact of the KZN flood damage. Please shed a bit of more light on this divergence of revenue and EBIT. And with Versapack out of the plastics division, could you provide an indication of market targets of the plastics division going forward?
So the biggest impact on profitability in the plastics business was the bins and crates business, which was more than the KZN floods. And that was related to the factors that I mentioned. On the one hand, lower sales to the fruit sector, which hopefully we can recover in the second half. And secondly, just some operational issues, which we had, especially at the beginning of the year. I mean, most of that variance came in the first quarter. And so that has been the main source of the decline in plastics. I should just point out that in the plastics business, the first half profit comparisons are a little can be a little misleading, because we make most of the profit in plastics, and specifically in the bins and crates business in the second half of the year, most years, you know. So it can often, you know, a small variance in the first half can lead to a big percentage variance. And so hopefully we can pull that back in the second half. You know, we are progressing well on the projects, but we didn't get the benefits that we'd hoped in the first half from the bins and crates business, because of some of the delays in the equipment deliveries, and also some operational challenges we had in the first quarter.
So with Verspac out of the plastic.
Sorry, so the question was a margin. Yeah, the margin. So sorry about that. The margin, we still expect in the plastics business to see a margin between 8 and 10%, an EBIT margin, and that target remains as such.
Thank you. Anton Smith from Peregrine Capital. Were there any costs associated with the Baywhite agreement, or was it just incremental profit?
No, yeah, I'd say the 2.5% margin was incremental profits, after the costs, if I was to put it like that. That's probably the best way to explain it.
Second question from Anton. Can you please give an update if there is one regarding discussions with Caxton post the special resolutions being downvoted at the most recent AGM? And any update from the ComCom tribunal hearing?
So, well, let's start with the ComCom tribunal hearing. So we haven't had any feedback from the tribunal in regard to that hearing, which was done on the 6th of June, I think the date was. So we're still awaiting the outcome of that. I mean, in terms of the AGM, so I take it you're referring to the voting down of the NED fees. And I must just start by saying we are very grateful to our non-executive directors who have continued to serve the board and with their commitment to Mpact, even in the face of this conduct by Caxton. As stated in our SENS, following that AGM, the NEDs have confirmed that they'll continue to serve on the board for the time being. Some of our board members have engaged with Caxton since the AGM to understand their concerns relating to the fees. Unfortunately, up until now, that we've been unable to find common ground, as it's clear that their conduct is underpinned by a different motive, leaving us in a rather invidious position when it comes to the NED fees. Notwithstanding that, we are, of course, taking legal advice regarding our options to protect the interests of the company, while also ensuring that we remain compliant with the Companies Act, the JSE listing requirements, and the applicable governance standards. So beyond that, I can't really give you any more feedback at this point in time.
Thank you. Murray Moore, what does the supply side of the South African paper market look like at the moment? Any competition from imported paper?
So I'd say, as I did say in the outlook, the supply-demand balance is still very tight. So there's not enough supply to meet the current demand in the local market. And it's probably underpinned by the inability or the very difficult circumstances in importing a competing product. So we are seeing, for the time being, less imports in South Africa. And even if you can get those imports, they are quite substantially high in cost, even after our increases that we hope to get through in October. So the situation is tight. Having said that, if I was just thinking for myself, for us, this is a cyclical business. The cycle will turn at some point, and we're having to constantly be on the lookout to make sure we're not sitting on the wrong side of that turn when it does come. But it's very uncertain as to when that might be. But for the time being, demand is strong, and most of our paper mill capacity is sold out at the moment.
Thank you. Just a reminder that if you would like to post any questions, you can use the tab at the bottom of your screen.
Are there no further questions, Molly's? Are there any more questions?
No, there are no further questions. So on behalf of Mpact, we would like to thank you for your participation. Goodbye.